It's been a long and exciting day, and we've heard about a lot of things: trade policy, regulation of the tech giants, cybersecurity. Not always completely uplifting, the discussion, but at least I hope that everyone who's here today leaves with lots more information and lots more curiosity about what we discussed today. But I know that you're all very much looking forward to hearing from our next and final speaker, so I'm going to keep this introduction brief, also because I recognize on East Coast time it is now 10:15 p.m. for our speaker, so I want to be sensitive to that. So first, one reminder is that tonight's event is being live streamed on SIEPR's Facebook page, and it is also being recorded, so we'll have the videos up on our website soon, siepr.stanford.edu, in just a few days. I am just absolutely thrilled and honored that Jerome Powell, the chair of the Federal Reserve, is here with us tonight. He really exemplifies the type of policymaker we strive to engage with here at SIEPR. As many of you know, quite a few of our faculty work on monetary policy, and their work is quite relevant to what the Fed is doing, but it is really inspiring for them and for all of us to connect with someone like Chair Powell, who is on the front lines of policy. And it is, I think that we have here tonight with Chair Powell. He's in a relatively good mood. Just over a week ago, he was telling the Senate Banking Committee that the U.S. economy is healthy and the outlook is good, but ever vigilant. We always know that there's always risks on the horizon, and he did signal slowing global growth as a risk to our economy. With inflation low right now, he said the central bank is being patient in its approach to interest rates and so forth. We'll hear more about that, I'm sure. But I suspect it's been a very exciting time for him since he took the helm of the Fed in February 2018. But he'd already been at the Board of Governors since 2012, and I think he'll be wrapping up soon his seventh. He's well into his 7th year at the Board of Governors, and he's really had an incredible career, and I can't do justice to all of it, but let me just take a few highlights from this. He has, prior to his appointment at the Board of Governors and now the chair of the Fed, Chairman Powell was a visiting scholar at the Bipartisan Policy Center in Washington, D.C., where he focused on federal and state fiscal issues, which were important then and are certainly important now. And before that, for many years, he was a partner at the Carlyle Group. He served as an assistant secretary and as an undersecretary of the Treasury under President George H.W. Bush, with responsibility for policy on financial institutions, the Treasury market, and related areas. And before that, before joining the Bush administration, he worked in investment banking previously. In addition to his service on corporate boards, Chair Powell has served on the boards of charitable and educational institutions, including the Bentheim Center for Finance at Princeton University. We won't hold that against him here at Stanford. And the Nature Conservancy of Washington, D.C. and Maryland. Before his professional career took off, he received his bachelor's degree in political science from Princeton and earned his law degree from Georgetown. And I'm really so thrilled, so delighted, so honored that Jerome Powell is here with us tonight at the Stanford Institute for Economic Policy Research. So please join me in welcoming him tonight.
Thank you very much, Mark. It's great to be here. I had a chance to spend some time this afternoon with a group of people, including some of the real greats of my lifetime in economics and public policy, so the honor is all mine. SIEPR is a place dedicated to scholarship supporting policies that better people's lives. Since today is International Women's Day, I would like to preface my remarks by commending the American Economics Association for highlighting the diversity challenges of the economics profession and charting a way forward. Diversity is also a priority at the Fed. I want the Fed to be known within the economics profession as a great place for women, minorities, and others of diverse backgrounds to be respected, listened to, and happy. So, just over 10 years ago, the Federal Open Market Committee, which I will call the FOMC or the committee, lowered the federal funds rate close to zero, which we refer to as the effective lower bound, or the ELB. There'll be a few acronyms here. Unable to lower rates further, the committee turned to two novel tools to promote the recovery. The first was forward guidance, which is communication about the future path of interest rates. The second was large-scale purchases of longer-term securities, which became known as quantitative easing, or QE. There's a range of views, but most studies have found that these tools provided significant support for the recovery. From the outset, the committee viewed them as extraordinary measures to be unwound or normalized when conditions ultimately warranted. Today I'm going to explore some important features of normalization and then turn to what comes after. In some ways, we are returning to the pre-crisis normal. In other ways, things will be different. The world has moved on in the last decade, and attempting to recreate the past would be neither practical nor wise. As normalization moves into its later stages, my colleagues and I also believe that this is an important moment to take stock of issues raised by the remarkable experiences of the past decade. We are therefore conducting a review of the Fed's monetary policy strategy, tools, and communication practices, and I'll conclude with some thoughts on that review. So to start with balance sheet normalization. Between December 2008 and October 2014, the Federal Reserve purchased $3.7 trillion in longer-term Treasury and agency securities in order to support the economy, both by easing dislocations in market functioning and by driving down longer-term interest rates. Consistent with the committee's long-stated intention, in October 2017, we started the process of balance sheet normalization. We began gradually reducing the reinvestments of payments received as assets matured or were prepaid, allowing our holdings to shrink. And the process of reducing the size of our balance sheet is now well along. To frame the discussion of the final stages of normalization of the size of the balance sheet, it's useful to consider what the phrase normal balance sheet meant in the decades before the crisis. During that period, the main monetary policy decision for the FOMC was choosing a target value for the federal funds rate. Subject to that choice, the Fed allowed the demand for our liabilities to determine the size of the balance sheet. This is a feature of normal that we are returning to. After normalization, the size of the Fed's balance sheet will once again be driven by the demand for our liabilities, and I'll go into this in some detail. To see what that means, consider Figure 1, which shows the size of the Fed's balance sheet through time, as measured by total liabilities. So green is currency. The Fed issues currency, so to us that's a liability. I'll call that orange, is reserve balances, which is cash held at reserve banks. So that you can see the values are stated as a percentage of the dollar value of GDP. And as you can see, liabilities began to grow sharply at the end of 2008 with quantitative easing and continued to increase until the end of 2014. Since that time, liabilities relative to GDP have fallen appreciably. To understand these changes, it's useful to focus on a snapshot of the balance sheet at 3 points in time in Table 1. The left column is before the crisis, 2006. The second column from the left is when the balance sheet was at its largest at the end of 2014. And the third column is the end of 2019, a projection for the end of this year. So in 2006, the dominant liability was currency held by the public, and the dominant asset was Treasury securities. QE increased the balance sheet from just below 6% of GDP to nearly 25% by the end of 2014. That's the bottom line in the chart. Balance sheets have to balance, of course, and the Fed issued reserves as payments for the assets purchased. This action pushed reserves to nearly 15% of GDP. The committee has long said that the size of the balance sheet will be considered normalized when the balance sheet is once again at the smallest level consistent with conducting monetary policy efficiently and effectively. Just how large that will be is uncertain because we do not yet have a clear sense of the normal level of demand for our liabilities. Current estimates suggest, however, that something in the ballpark of that 2019 projected value may be the new normal. The new normalized balance sheet may be smaller or larger than that estimate, and it will grow gradually over time as demand for currency rises with the economy. But in all plausible cases, the balance sheet will be considerably larger than before the crisis. So to understand the differences between the new and the old normal, consider the final column on the right in the table, which shows the change measured in percentage points of GDP between the end of 2006 and the end of 2019. In this estimate, relative to before the crisis, the balance sheet will have grown by about 10.6 percentage points relative to GDP. Bank reserves account for the biggest part of that growth, or 5.6%. Why are they there? The crisis revealed that banks, especially the largest and most complex, faced much more liquidity risk than had previously been thought. Because of both new liquidity regulations and better management, banks now hold much higher levels of high-quality liquid assets than before the crisis. And many banks choose to hold reserves as an important part of their strong liquidity position. That's why reserves are higher than they were before the crisis. The rest of the increase in liabilities is accounted for by three other categories. First, public currency holdings will have grown by 2.4 percentage points as a share of GDP. Second, the U.S. Treasury now maintains an account at the Fed which has been running 1.4 percentage points higher as a percent of GDP. And third, there are other liabilities which are mainly associated with the mechanics of the national and international financial system will have grown by another percentage point. As was the case before the crisis, the FOMC's chosen operating regime for controlling short-term interest rates also plays a role in determining the appropriate quantity of reserves. In January, the committee stated its intention to continue in our current regime, in which our main policy rate, the Fed funds rate, or possibly some successor, is held within its target range by the interest rates we set on reserves and on the overnight reverse repo facility. In this system, active management of the supply of reserves is not required. Thus, the supply of reserves must be ample in the sense of being sufficient to satisfy reserve demands, even in the face of volatility in factors affecting the reserve market. To put it another way, the quantity of reserves will equal the typical reserve demands of depositories, banks, plus a buffer to allow for reserve market fluctuations. While the precise level of reserves that will prove ample is uncertain, standard projections, such as those on this table, suggest that we could be near that level later this year. As we feel our way cautiously to this goal, we will move transparently and predictably in order to minimize needless market disruption and risks to our dual mandate objectives. The committee is now well along in our discussions of a plan to conclude balance sheet runoff later this year. Once runoff ends, we may, if appropriate, hold the size of the balance sheet constant for a time to allow reserves to very gradually decline to the desired level as other liabilities, such as currency, increase. We expect to announce further details of this plan reasonably soon. There is no real precedent for this balance sheet normalization process, and we have adapted our approach along the way. In these final stages, we will adjust the details of our normalization plans if economic and financial conditions warrant. After decisions regarding the size of the balance sheet have been made, we will turn to remaining issues such as the ultimate maturity composition of the portfolio. The committee has long stated that it intends to return to a portfolio consisting primarily of treasuries. I'll turn now to a discussion of forward guidance and the normalization of policy communication. The committee has also been normalizing communication about our policy after a decade of forward guidance. Since 2008, the December's post-meeting statement had contained ever-evolving forms of guidance about keeping the federal funds rate at the effective lower bound, or about the gradual pace at which the rate would return to more normal levels. We removed the last elements of this crisis-era guidance in January. The federal funds rate is now within the broad range of estimates of the neutral rate, that is, the interest rate that tends neither to stimulate nor restrain the economy. Committee participants generally agree that this policy stance is appropriate to promote our dual mandate objectives of maximum employment and price stability. Future adjustments will depend on what incoming data tell us about the baseline outlook and risks to the outlook. Policy communication will not simply revert to the ways of the early 2000s, however, for transparency advances have continued apace since then. The most significant change from the standpoint of forward guidance is that since January 2012, the FOMC's quarterly summary of economic projections has included federal funds rate projections reaching up to 3 years into the future, often referred to as the dot plot. So these dots, for those of you who are not regular Fed watchers, these dots are a very important part of our public communication and attract a lot of attention. Returning to a world of little or no explicit forward guidance in the FOMC's post-meeting statement presents a challenge, for the dot plot has, on occasion, been a source of confusion. Until now, forward guidance in the statement has been a main tool for communicating committee intentions and minimizing that confusion. For example, in early 2014, the committee's intentions were at odds with a common misreading of the dots, and Chair Yellen explained, quoting, "One should not look to the dot plot, so to speak, as the primary way in which the committee wants to, or is, speaking about policy to the public at large. The FOMC statement is the device that the committee as a policy-making group uses to express its opinions about the likely path of rates." That ends the quote. So if the committee remains largely out of the business of explicit forward guidance, we'll need to find other ways to address the collateral confusion that sometimes surrounds the dots. As readers of our minutes will know, at our last meeting in January, there was an impromptu discussion among some participants of general concerns about the dots. My own view is that if properly understood, the dot plot can be a constructive element of comprehensive policy communication. So let me follow my two predecessors as chair in attempting to advance that proper understanding. Each participant's dots reflect that participant's view of the policy that would be appropriate in the scenario that he or she sees as most likely. As someone who has filled out an SEP projection 27 times over the last 7 years, I can say that there are times when I feel that something like the most likely scenario I write down is indeed reasonably likely. At other times, when uncertainty around the outlook is unusually high, I dutifully write down what I see as the appropriate funds rate path in the most likely scenario, but I do so aware that this projection may easily be misinterpreted, for what is most likely may not be particularly likely. Very different scenarios may be similarly likely. Further, downside risks may deserve significant weight in policy deliberations. In short, as Chairman Bernanke explained, the SEP projections are merely inputs to policy that do not convey, quote, the risks, uncertainties, all the things that inform our collective judgment. Effectively conveying our views about our risks and their role in policy projections can be challenging at times, and we're always looking for ways to improve our communication. And I've asked the Communications Subcommittee of the FOMC to explore ways in which we can more effectively communicate about the role of these projections and the dots. For now, I'll leave you with a cautionary tale about focusing too much on dots. Here is a picture composed of different colored dots. And I would say the meaning of it is not clear, although you will find if you stare at it long enough, you may see a pattern. But let's take a step back. As you can see, if you're too focused on a few dots, you may miss the larger picture. Okay. Thank you. I mean, as monetary policy jokes go, you know, that's as good as it gets, okay? So, delivering on the FOMC's intention to ultimately normalize policy continues to be a major priority at the Fed. Normalization is far along, and considering the unprecedented nature of the exercise, it's proceeding smoothly. I'm confident that we can effectively manage the remaining stages. Moving to the review, my last topic. We live in a time of intense scrutiny and declining trust in public institutions around the world. At the Fed, we are committed to working hard to build and sustain the public's trust. The Fed has special responsibilities in this regard. Our monetary policy independence allows us to serve the public without regard to short-term political considerations, which, as history has shown, is critical for sound monetary policy making. But that precious grant of independence brings with it a special obligation to be open and transparent, welcoming scrutiny by the public and their elected representatives in Congress. Only in this way can the Fed maintain its legitimacy in our democratic system. Among other initiatives, my colleagues and I on the FOMC are undertaking a year-long review of the Federal Reserve's monetary policy strategy, tools, and communications practices. The review will involve a series of Fed Listens events around the country, These will include town hall style meetings and a conference where academic and non-academic experts will share their views. These events will inform staff work and FOMC discussions as we plan for the future. While this is the first time the Fed has opened itself up in this way, many central banks around the world have conducted similar reviews, and our approach builds on their experience. We believe that our existing framework for conducting monetary policy has generally served the public well, and the review may or may not produce major changes. Consistent with the experience of other central banks and similar reviews, the process is more likely to produce evolution rather than revolution. We seek no changes in law, and we're not considering fundamental changes in the structure of the Fed or the 2% inflation objective. So while there's a high bar for adopting fundamental change, it simply seems like good institutional practice to engage broadly with the public as part of a comprehensive approach to enhanced transparency and accountability. Without ruling out other topics, we've highlighted 3 questions that seem particularly important for the review. The first is, can the Fed best meet its statutory objectives with its existing monetary policy strategy, or should it consider strategies that aim to reverse past misses of the inflation objective? Second, are the existing monetary policy tools adequate to achieve and maintain our statutory goals, or should we expand the toolkit? And third, how can our communication of our policy framework and implementation be improved? And I'd like to spend a few minutes discussing the first topic. Because interest rates around the world have steadily declined for several decades, rates in normal times now tend to be much closer to 0 than in the past, as you can see from this figure. These are advanced economies, and you can see long-term interest rates in all these countries have come down quite a lot over the 3-decade period of the chart. Thus, when a recession comes, the Fed is likely to have much less capacity to cut interest rates to stimulate the economy than in the past, suggesting that trips to the effective lower bound may be more frequent. The post-crisis period has seen many economies around the world stuck for an extended period at the ELB, with slow growth and inflation well below target. Persistently weak inflation could lead inflation expectations to drift downward, which would imply still lower interest rates, leaving even less room for central banks to cut interest rates to support the economy during a downturn. It is therefore very important for central banks to find more effective ways to battle the low inflation syndrome that seems to accompany proximity to the effective lower bound. In the late 1990s, motivated by the Japanese experience, economists began developing the argument that a central bank might substantially reduce the economic costs of the effective lower bound spell by adopting a makeup strategy. The simplest version of it goes like this. If a spell with interest rates near the effective lower bound leads to a persistent shortfall of inflation relative to the central bank's goal, once that spell at the lower bound ends, the central bank would deliberately make up for lost inflation by stimulating the economy and temporarily pushing inflation modestly above target. In standard economic models, if households and businesses are confident that this future inflationary stimulus will be coming, that prospect will promote anticipatory consumption and investment. And that could substantially reduce the economic costs of the trip to the lower bound. Researchers have suggested many variations on makeup strategies. For example, the central bank could target average inflation over time, something that's getting some discussion right now, implying that misses on either side of the target could be offset. Now, by the time of the crisis, there was a well-established body of model-based research suggesting that some kind of makeup strategy could be beneficial. And in light of this research, one might ask why the Fed and other major central banks chose not to pursue such a policy. And the answer lies in the uncertain distance between models and reality. For makeup strategies to achieve their stabilizing benefits, households and businesses must be quite confident that the makeup stimulus is really coming. This confidence is what prompts them to raise spending and investment in the midst of a downturn. In models, confidence in the policy is merely an assumption. In practice, when policymakers considered these policies in the wake of the crisis, they had major questions about whether a central bank's promise of good times to come would have moved the hearts, minds, and pocketbooks of the public. Part of the problem is that when the time comes to deliver the inflationary stimulus, that policy is likely to be unpopular, what is known as the time consistency problem in economics. Evidence from the United States and around the world suggests that more frequent Effective lower bound episodes could prove quite costly in the future. My FOMC colleagues and I believe that we have a responsibility to the American people to consider policies that might promote significantly better economic outcomes. Make-up strategies are probably the most prominent idea and deserve serious attention. They are largely untried, however, and we have reason to question how they would perform in practice. Before they could be successfully implemented, there would have to be widespread societal understanding and acceptance. As I suggested, a high bar for any fundamental change. In this review, we seek to start a discussion about make-up strategies and other policies that might broadly benefit the American people. To wrap up, tonight I've focused on policy normalization and our efforts to engage the public in what may come after. Before concluding, I'll just say a few words on current conditions and the outlook. Right now, most measures of the health and strength of the labor market look as favorable as they have in many decades. Inflation will probably run a bit below our objective for a time due to declines in energy prices, but those effects are likely to prove transitory. Core inflation, which is often a reliable indicator of where inflation is headed over time, is quite close to 2%. Despite this favorable picture, we've seen some cross currents in recent months. And with nothing in the outlook demanding an immediate policy response, and particularly given muted inflation pressures, the committee has adopted a patient wait-and-see approach to considering any alteration in the stance of policy. Considering monetary policy more broadly, we are inviting thorough public scrutiny and hoping to foster a conversation regarding how the Fed can best exercise the precious monetary policy independence we've been granted. Our goal is to enhance the public's trust in the Federal Reserve, our most valuable asset. Thank you very much for listening. I'll look forward to our discussion.
Thanks, that's great. Thanks. I couldn't see the dot plot, but it sounded good from what I heard. So I just want to give a thank you right off the bat to my friend and colleague, Michael Boskin, former SIEPR Director, who helped to connect us with Chair Powell. So thank you very much, Michael, for this. Now, think of Michael also because prior to, you may know that we asked for questions in advance when we sent out the summit confirmation emails. And we received many suggestions, many excellent suggestions, more excellent suggestions than I could possibly fit in. And, but Michael, you definitely got a question in here, so you'll be happy to know that. And I have edited them for brevity and clarity, I hope. But we had more than, so if your question didn't make it in and you're not happy about it, I guess it's my fault. So apologies in advance for that. But Chair Powell, you spoke about the Fed Listens tour and the review of Fed policies that sort of underway. And I wonder if you can give us some specific examples of monetary policy strategies, tools, communication that might benefit from review and revision as this process goes forward.
I'd be glad to. I just want to stress that this is the first time we've done something like this, and just the fact of doing it is itself, I think, the most important thing about it. We've opened ourselves up to a public dialogue. It seems like a good thing to do, and I'm very happy and excited about this. So some of the things we'll be looking at, we're looking at a wide range of things. You asked particularly about the tools, and I guess I'd break them into three categories. First, we did use two unconventional tools in the wake of the financial crisis. As I mentioned, QE and forward guidance. So we'll be looking at, how effective were those? There's an ongoing debate, even 10 years later. How effective were they? Are there better ways to do them? And things like that. So that's one thing. There are also tactics or strategies that other central banks around the world used and the Fed chose not to use. And two in particular come to mind. One is having the policy rate go below zero, negative interest rates. And another one is actually capping the rate on longer-term securities, which the Bank of Japan has done. So we didn't do those things. We looked at them at various times and chose to do different things. But so we can now look at them and see how they worked in other institutional settings in different countries around the world and gain knowledge from that. Then there were things that the third category would be things that no one did do, and those are principally the makeup strategies, of which there are many. One I didn't mention is rather than making up lost inflation, you could make up lost accommodation. This is one that I've talked about often with Professor Taylor. And the idea is that if you're stuck at the lower bound and the policy rule says you should go negative, but you can't, you sort of store up that accommodation. So there are a variety of make-up strategies, and those, we have to take seriously this problem of the lower bound and the fact that we're so close to zero even when rates are at neutral. This is a problem for central banks around the world, and we owe it to the public to find out now, during good times really, when we're not at the zero lower bound, what we would do in that situation, because it's much more likely to arise. And we have all of the experiences we have to date of economies that go to the zero lower bound involve long periods of low inflation and low growth. So we need to try to find a better approach to that.
So you mentioned in your remarks the inflation objective of 2% as being sort of quite consistent in the longer run with the assigned mandate of price stability, but there's been some debate in the economics profession, actually a lot of research done by faculty affiliated with SIEPR about the challenges of accurately measuring inflation, a number of people here, including Professor Boskin, have done this sort of work. Does the Fed have a position on whether inflation has been and is being properly measured, and how do you think about that with respect to this price stability part of the Fed mandate? We don't have an official position on it, though, but of course we're well aware of these issues. I mean, the fundamental issue is that it's very hard to incorporate quality changes, ongoing quick quality changes due to evolving technology. You know, where prices are going down and the quality is going up with technology. How do you calculate inflation? How do you calculate economic output? How do you calculate productivity increases? It's very, very hard, and there's a whole great deal of research going on. Some terrific Fed people are involved in that research. So that's something that we are constantly working on. I think that there's been a general finding since the Boskin Commission that inflation is actually lower than the measures say it is. So we try to take that into account. The real thing with inflation, though, that I would say is more top of mind now is just that all over the world you have disinflationary pressures. You have below target inflation in many economies, advanced economies particularly around the world. And so it's a different problem than the one we grew up with, which was high inflation. Since the mid-90s, really, inflation's been low and stable in the United States. And a question, we want to keep it low and stable, but a question is raised by the proximity to the zero lower bound, as I suggested in my remarks, that we need to make sure that inflation doesn't keep slipping down towards zero, because then the central bank really does have less and less ability to react to downturns. Great, thanks for that. Next, could you tell us whether recent changes in Fed policy are due to changes in inflation or the cyclical position of the economy, or whether the recent changes reflect a departure from monetary policy rules the Fed has used, or some combination?
So monetary policy is a forward-looking exercise, and you can break it down into what is the outlook and what are the risks to the outlook. And so I think what's happened in the last really about 6 months is you've seen economies around the globe slowing a bit. 2017 was a year of synchronized global growth. 2018 was a year of slowing. And since really the beginning of the fourth quarter, we've seen growth slowing in Western Europe, in China, and now in the United States a bit. So you're seeing, that's one thing. So the outlook is still a positive one, still a favorable one, but the outlook itself is for lower growth than what we had last year, but still healthy growth, I would say. The second thing that's changed, though, is the risks to the outlook. The downside risks have increased, both because of the slower growth, but also because of event risks like Brexit. And frankly, the trade negotiations have added uncertainty and we hope there's a positive outcome there, but they've added uncertainty, which has created some downside risk. So that, I think those are the two main drivers of what has been a change in our policy stance that I would point to.
So given the differing proposals that are out there or that you may come to on what strategies might work best in a low-rate world, how will the Fed vet and arbitrate any proposed changes to its monetary policy approach?
You know, part of the idea is of this review is to have a two-way conversation and you know, bring these issues to as broad an audience as we can, and I think it has to start with public understanding. Now, these strategies only work if they're well understood and credible, and I think we have some work to do on that front. So a big part of what we're doing is talking about the zero lower bound problem in all of these events at the 12 reserve banks, and not just with economists, by the way. We have groups from all parts of American society coming in who have, they're all stakeholders in our policy in a way. So the idea is to have a conversation and raise the profile of these issues, and it's not just a question of what works in the models. You know, it has to be practical. It has to be practical and work in the real world, and I think that's where the make-whole strategies are challenging, but they are promising.
Great. There's been a fair amount of research, including some by faculty here at Stanford, suggesting that monetary policy changes can have pretty significant distributional consequences. So can you help give us a sense of whether and how the Fed takes these into account when setting interest rates or considering changes in the policy mandate?
So I'm going to take the premise on a little bit. It's a very challenging thing to figure out, if you will. We're charged by Congress with using our interest rate tools to achieve maximum employment and stable prices. That's our job. And I think if you look back, the job creation in this post-crisis era has been very strong. For a long time, wages weren't going up enough, and they are going up more now, but job creation was strong, and some of that should be credited to highly accommodative monetary policy. And that's helping people who are out of work. You can point to the fact that monetary policy works through both financial assets and housing prices as well, and that supports consumption and investment. And financial assets tend to skew to wealthier people. Housing is much more of a middle-class asset, but still, homeowners are still middle-class people at least. And you can say that there are distributional effects there, but I think you need to look at the people who are being helped as really the people who are out of work. So I really question the premise of there being bad distributional effects. And in terms of us taking it into account, you know, we wouldn't hold back from, we will use our tools to achieve the goals Congress has given us, which is maximum employment and stable prices, not other goals, which are jobs for other agencies or Congress itself.
So you referred in your remarks to the possibility of sort of moving to some sort of average inflation targeting or price level targeting, where there would be some sort of built-in catch-up in the policy. Can you just give a high-level sense of how, if such a change were to be decided on, how would the Fed go about introducing a change like that?
Well, I think to introduce it would be a relatively long process. There's a sense in some commentary that this is something we've already decided and are going to be announcing, you know, in coming months. It's just not the case. We're at the very beginning of a process of deeply engaging with these strategies and talking about them publicly. As I mentioned, they have to be to work. What makes them work so well in the models is the assumption that the public perfectly understands them and acts upon them as though it believes them completely. So those are assumptions that are not in congruence with reality. If you work on monetary policy, you realize that quickly that most people do not walk around thinking about monetary policy all the time. I mean, incredible as it may seem. So I think the framework that we've had, which is essentially an inflation targeting framework with a maximum employment mandate, has worked all around the world so well for a couple of decades now to get inflation under control, stable. That was not the case, 40 years ago. Inflation was a serious problem. It's been under control, and this framework has served the public very well. So the bar for making fundamental changes on it is a high one, but the obligation to find better ways to deal with the zero or lower bound is also a high one, because we're going to need better tools and better ideas about that in all likelihood, because rates, the things that are driving interest rates lower are long-term trends like demographics and the aging of the population, appetite for safe assets, which probably relates to demographics, slower productivity growth, things like that. So there is every reason to think that rates will stay low. So the process of getting to one of these makeup strategies like average inflation targeting is likely to be a long and careful one, because it does depend on public understanding. So I think the first step in that process, Mark, is to have a process like this where we bring this idea to the public and discuss it.
I'd like to next move on to the federal deficit, debt, and debt ceilings. I think that the most recent suspension of the debt ceiling expired pretty recently, and the CBO projected the Treasury will run out of cash around October of this year unless Congress acts to raise or suspend the debt ceiling. And so, can you talk? I know you've been involved in previous discussions about debt ceiling, and so I'm curious, as we come up in the months ahead, what should be done, why it's important, and
Well, the debt ceiling is what the debt ceiling is a law that says you can't issue more debt than a certain amount, and the problem with that is that Congress will have already authorized the spending, and the spending will already be happening, but has to pass another bill to allow Congress to pay for the spending that it's already ordered. So we are, I think, unique among major economies in having this second vote. I would just say this. The idea that we would not vote to raise the debt ceiling and default on our payments is something that would put the economy, that kind of a thing would put the economy at great risk. And it's just not something that we should be contemplating. It's not a way for the world's greatest democracy to run its fiscal business, in my opinion. That said, we face real fiscal issues, and it's not our job. We don't do fiscal policy. We don't give Congress advice or the administration advice. So we limit our comments to fairly high-level ones. And I would just point out that the U.S. federal budget is on an unsustainable path and has been for a long time, and we will have to address that over time. We won't have any choice. The sooner we address it, the less painful it will be. I'm not calling for anything now. I mean, I think there's a very important discussion to be had about how you do that, what mix of taxes and spending, and in what timing, at what time in the business cycle. All of those things are things that are completely out of our control and on which I would express no opinion. But I just hope that it will remain in our thinking that this is something we really need to get back to. That's all.
So related to that, there's been a growing set of individuals who are arguing that perhaps the government doesn't need to worry about deficits and debt related to this theory known as modern monetary theory. So wondering if you can comment a bit on MMT.
Maybe a little. I have to say it's not easy to pin down exactly what the theory is. I think with the standard framework we know what it is, and it's very hard to pin it down. And so I don't want to try to take it apart, because honestly I'm uncertain about some aspects of it. But one aspect is that the idea is that Congress would sort of manage. If inflation goes up, that would be Congress's issue, not the Fed, and that the central bank would keep interest rates low for a very long time and not be involved in sort of cyclical management. That's the opposite of how we do it right now. I don't think this is something that we're seriously considering changing, but it's an interesting thing for people to work out in more detail. There is also this idea that I've seen expressed that if you borrow in your own currency, then you can never go wrong, and I just don't think that's right. I think there's plenty of evidence that you can go wrong. We do have a budget constraint, even though we're the world's reserve currency. So, again, I just hope this is, we need to get back to this. We seem to have lost track of this issue in fiscal space. It's not our issue, but.
So, in the last several years, significant amount of economic activity has migrated to the shadow banking sector, and wondering what the Fed's thinking is on this sector and on the risks that reside there.
So we have the world's most highly developed and active, innovative capital markets. Our financial system is more oriented to the capital markets than to the traditional banking system than most, or I think any other major economy. So a lot of intermediation between savers and borrowers happens in the capital markets or investors rather than through the banking system. If you go to many advanced economies, it's all happening in the banks, and the banks are much more highly regulated. And so I think, I'll get to how we have to be thinking about the capital markets in a second, but we need to remember that that's a strength as well. There's innovation there. There's the ability to raise capital. And so I think we need to be very careful about how we regulate the capital markets and not necessarily import the much more intensive prudential regulation that takes place in the banking system. But that said, what we saw in the financial crisis was that there were systemically important activities going on away from the regulated banking system that were not being regulated. And I could name a bunch of them. Most of them are not especially well known, but little pieces of the payment system and money markets, for example, the money markets are clearly systemically important. So, and we've gone after things that were a specific problem in the crisis, like the tri-party repo market and the money markets and other things. But you have an issue of wanting to carefully monitor activity in what we call the shadow banking system, which is the non-banks, and make sure that you're watching in case something of really systemic risk does arise. So we do that. We do it, and we have this thing called the Financial Stability Oversight Council, which is very focused on these issues. And I'll point to a current issue that really fits well with this story, and that is just leveraged lending. So lending to highly leveraged companies is something that's always happened, and it's, in a sense, it's an important economic activity, but there's been a tendency for those markets to overheat. Companies overborrow and there are defaults, and the companies can't do what they're supposed to do for consumers, and investors lose money, and it can be an amplifier for a downturn. It can amplify a downturn. So what's happened post-crisis, this was not a big part of the financial crisis, but it was a part. Post-crisis, the banks are now much more carefully managing the risks that they take with leveraged lending. The risks, to a much greater extent, are not on their balance sheets anymore, and they didn't make these long-term promises to underwrite things. Their pipeline is much smaller. But the risk went out of the banking system, and that's probably a gain to financial stability because it was the banking system, that was the place where financial stability really got undermined. So, but now that risk is held in the shadow banking system. It's held in mutual funds. It's held in collateralized loan obligations, collateralized debt obligations. So these are standalone vehicles that are holding all these things. And so we monitor them very carefully to make sure that they don't present systemic risk. And we don't think it's really a systemic risk issue, but we do think it's a macroeconomic issue. Because if borrowing binges don't tend to end happily, let's say. And that's what this is a lot of borrowing going on by highly leveraged companies. So, I will say we're using our regulatory tools with the banks, and we're monitoring what's happening in the non-banks very carefully.
So before the financial crisis, there was a quite active overnight credit market between banks, the federal funds market. But with quantitative easing, the banking system has become somewhat flush with reserves. Banks don't need to borrow and lend reserves from each other, reducing the need for an overnight credit market between banks. Do you think that it would be a good thing to reduce the amount of reserves that banks have? What are the sorts of trade-offs that are involved?
Yeah, I'll tell you why I don't think it would be a good thing. We're providing, the appetite for liquidity is holding liquid assets. The appetite is much higher than it was before the financial crisis. Not only the appetite, the requirement that they hold lots and lots of liquid assets is much higher than it was before the financial crisis. And this is a good thing. Liquidity, large financial institutions tend to fail because of liquidity problems rather than solvency problems most of the time. So, and reserves are the, money on deposit at a Federal Reserve Bank is what a reserve is. It's immediately available funds, and it's probably the single most liquid, reliable asset. So we think there's a lot of social benefit in having ample liquidity. And why, you're right, we could go back to a world where reserves were quite scarce and trading between banks was the way we controlled the quantity, and banks had to meet reserve requirements, and that's how the federal funds rate was set then. Now we control it through our policy rates that I mentioned, and we don't need to go back to that. Our operating system works very well, and I think we'd lose the social benefit of high liquidity if we drove down the quantity of reserves, so I wouldn't do that.
Thanks. So we had a jobs report this morning, and I didn't get the opportunity to dissect it all that much, but I did see that the unemployment rate fell to 3.8%. The jobs numbers were not super, but in any case, we have a very low unemployment rate. Inflation is low, not accelerating. This is to some extent uncharted territory, at least in recent decades, and why do you think inflation is so tame, given such a strong labor market?
It's a good question. I think if you have to go back in history and remember, the 1960s and 1970s, and we had much higher inflation then. And the way inflation would go up when the economy overheated or when resource constraints got tight, when the unemployment rate got low. It was called the Phillips curve. So basically, as the economy tightened, prices would go up. And then there was a second thing that happened, which was when prices went up, people think, oh, prices are up, I guess they'll keep going up. So there's this persistence effect. The combination of those two things led to high inflation and what we call a very steep Phillips curve. So the tighter the economy got, the lower unemployment went, the higher inflation went. So then comes Paul Volcker and inflation targeting, and central banks around the world establish really strong credibility in keeping inflation, a commitment to keeping inflation under control. And now the public starts to believe that inflation will remain pretty close to 2%. So for example, in the financial crisis, inflation doesn't go down. Whereas you would expect it to go down in really weak times, you expect it to go up, and so it doesn't go down in times when the economy is weak, and it doesn't go up very much when the economy is strong. And that, I mean, many people, and I would agree, attribute that to just very high credibility on the part of central banks. And so you have what I would call very attractive inflation dynamics that effectively we've inherited. One way to think about it, and I've heard I'm borrowing this from Ben Bernanke, is today's inflation dynamics, which is the flat Phillips curve and inflation that doesn't react to changes in slack, is a capital asset that we've inherited from Paul Volcker, Alan Greenspan, our predecessors. But like any capital asset, we have to maintain it or it will depreciate. Meaning, that doesn't mean the current set of inflation dynamics are not here by any law. It can change back if we ignore the old inflation processes. But today, it's just a fact that inflation is low and stable and doesn't react much to slack in the economy.
That's great. So I'd like to ask a question just going back to before you were at the Fed. You spent some time both in the policy worlds and in the private sector. And wondering if you can give a sense, I mean, a number of students I advise or teach or work with often express interest in sort of both worlds. And if you can give us a bit of a sense of has your experience in each of those orbits been beneficial to you in the other?
It has. So I'll just say, when I graduated from college in 1975, I really did not have any plan. But my thought was, I thought was that I wanted to have mainly a private sector career, but then go into the government and work in public policy, hopefully at rising levels. And I had two people in mind, honestly, two people. One of them was George Shultz. And the other was Cyrus Vance. Honestly, I thought, I was class of 75, I grew up in Washington, D.C., very focused on public policy. Those were the two people I thought about. That's what I want to do. So it just kind of happened. That's what happened. And I really do think our system is different from other, if you go to Western Europe, the people who work in government are people who work in government. That's what they've done with their careers. And maybe one job in the finance ministry or 3 jobs in the finance ministry will change when the government changes. Our system is different. People in all walks of life can come serve in the federal government, and probably they don't know, as I certainly didn't know as much about public policy when I came to work for President Bush, joining Mike Boskin in 1990. But you learn, and you bring your knowledge of the private sector, the experience of in a messy world, getting from point A to point B, in the business world or the legal world. I can only make you a better policymaker to have had that experience, I think. Of course, I would think that. But, so I think it's great, and I hope it stays that way. I really do. I mean, we've had a system where people can come and serve and want to serve, and I think it's a great thing. I think it's a really attractive, good aspect of our system, and for me, it's been great, I have to say. I really appreciate that.
So we have some students in the audience tonight, and there were many more students who wanted to be here who couldn't be. And if you're watching on the Facebook stream right now, I apologize to any of you who I couldn't get in. You can see the room is very full, couldn't get everyone in. But one of my students was curious, just wanted me to ask you this kind of fun question of what's the best thing about being the chair of the Federal Reserve? You've been in the job for more than a year, and so that was, she said, if I can't be there, can you ask him that question? And I thought, all right.
That's an easy one. It's just the honor of getting up every morning and having the honor to go to work and perform this role on behalf of the American people. It's the honor of a lifetime, and it's just doing it every day. I never forget that. You have to just pinch yourself, really, and so that's it. It doesn't get better than that, as far as I'm concerned.
Okay, great. Well, I think that's a great note to end on, so please join me in thanking Chair Powell.